Good day, everyone. I am Mary Jo Atilia and I'll be giving you a brief overview and outlining the issues about this case. Profit Company uses a retail inventory method to estimate monthly ending inventory, a practical approach for high-volume retail operations. For October 2025, detailed data is provided including inventory balances, purchases, markups, markdowns, and sales to compute ending inventory under LCNRV method. Additionally, Profit entered a purchase commitment with Huawei Corporation to buy merchandise at 300 pesos per unit, a total of 6 million pesos, while the current market price has dropped to 250 pesos per unit. This situation raises potential loss, recognition concerns under Pass 37 provisions, and inventory valuation under Pass 2. These are the issues identified. Inventory estimation using conventional retail method. What is the adjusted markups, markdowns, and spoilage? How to compute the cost of retail ratio and apply it to estimate ending inventory. Discrepancy and inventory. What is the possible cost of the difference between LCNRV value of 600,000 while the physical count is 470,000? Theoretical insight. What is the rationale and logic behind the retail inventory method? Purchase commitment dilemma. Helen, the controller, sees the need to record the loss as market price shows no sign of recovery. However, Ramon, the VP of Finance, believes that the loss is temporary and should not be recognized. Should the profit company recognize a loss based on market conditions? Ethical considerations and stakeholder impact. How should accounting professionals balance ethical responsibility with pressure from management when financial reporting decisions may mislead stakeholders? This will be answered through our detailed analysis and solutions.
For analysis, Instruction 1, we were asked to create a schedule for computing estimated LCNRV inventory using conventional retail method. To compute for gas conservative, we added net purchases, freight in, and markups to beginning inventory and deducted markup cancellations, which has a cost ratio of 67%. We then deducted net markdowns at retail to get the gas average, which has a cost ratio of 67.49%. Also, we deducted sales, normal spoilages, and breakage at retail to compute for the ending inventory at retail. To get the ending inventory at conservative cost, we multiplied the ending inventory at retail by the conservative cost ratio. To get the ending inventory at average cost, we multiplied the ending inventory at retail by average cost ratio, which gives us an LCNRV of 645,880. Next, we were asked to list the factors that may have caused the difference between the computed inventory and the physical count. First reason is shrinkage. These are unrecorded losses due to theft, pilferage, employee misappropriation, or errors not yet recorded. Second, unrecorded spoilage or damages. These are items that are deteriorated or broke but weren't recorded. Third, incorrect or unrecorded markup or markdown records. Errors in pricing or record keeping could inflate inventory estimates. Number 4, returns not recorded correctly. Sales returns or purchase returns may not have been reflected. Fifth is clerical or accounting errors. Errors in computing or recording purchases, sales, or adjustments. Sixth, incorrect retail prices. Overstatements or understatements of retail values used in estimation. 7. Timing differences. Inventory purchases or sales near month end not recorded correctly. Lastly, we were asked to explain the rationale behind the retail inventory method. The retail inventory method derives its name from the practice of tagging items with their selling or retail price. According to Pass 2, paragraph 22, this method is commonly used in the retail industry, particularly in department stores, supermarkets, and similar retail establishments that handle a large volume of rapidly changing inventory with relatively uniform margins. In such environments, it is often impractical to maintain detailed cost records for each unit, making the retail inventory method a practical alternative to traditional costing methods.
Hi, now let's move on to the ethical issues encountered by the profit company. First is the intentional misstatement of the financial statements. The financial VP is refusing to recognize a loss of 130,000 from a decline in the purchase contract value. This could mislead the stakeholders and compromise transparency. This would also violate the accounting principles, specifically the prudence or conservatism principle, which requires losses to be recognized when they become probable and measurable. And the result of this is misleading the investors and creditors who rely on truthful reporting to make sound decisions. Lastly, is there's a threat to professional integrity. The controller is being asked to act unethically, which could breach the code of ethics for professional accountants, specifically principles like integrity and objectivity. Now, next is for letter B. Is any particular stakeholder harmed by the financial vice president's decision? So there are five that are affected. First is the investors and creditors again. They could make poor decision based on distorted data. Next are the employees. Misrepresented finances might lead to wrong decisions about their bonuses, and some might be laid off, and the resource allocation. Third is the regulators and auditors. They might miss this misstatement, leading to further compliance issues. Fourth is the company itself. If the truth surfaces, profit company could face reputational damage and even legal consequences. Lastly, and most importantly, is the controller or Helen. She's at personal and professional risk if she goes along with the unethical accounting practice.
So now that we have analyzed the issues from both an accounting and ethical standpoint, here is the recommendation to enhance the entity's performance. So first is insist on proper recognition. The profit company should recognize the 1 million pesos loss from the purchase commitment. And according to IAS 37 provisions, losses from onerous contracts where costs exceed the expected benefits should be recognized immediately. And this approach also aligns with the accounting principle of conservatism, which states that the probable and measurable losses must be recorded without delay. And the next is document findings. So the controller must prepare clear documentation to justify this recognition, including evidence of the market price decline from 300 pesos to 250 pesos per unit, and lack of recovery signs and references to the past due and IAS 37. And this documentation will reinforce the accounting treatment and safeguard the controller against potential claims of bias or error. And then third is to communicate professionally. So the controller must professionally engage to Raymond, which is the VP of Finance, and clearly communicate the financial, legal, and ethical risk of omitting the loss. And for this is not just a numbers issue, it's a matter of transparency, stakeholders' trust, and professional ethics. And then fourth is seek higher authority or audit committee. If internal disagreements persist, we should escalate the issue to the audit committee or external auditors so they can provide an unbiased evaluation based on accounting standards and government policies. And then lastly, the fifth, whistleblowing if necessary. So if ethical pressure continue and proper reporting is compromised, the controller must adhere to professional codes and report the issue through formal whistleblower channels to safeguard public interest and stakeholder integrity. And together, these steps ensure that the company remains compliant with financial reporting standards, protects its reputation, and upholds ethical accounting practice. We believe this approach is the most responsible and sustainable course of action, both financially and ethically. Thank you.
This case highlights how practical tools like the retail inventory method help businesses efficiently estimate inventory, especially in fast-paced retail environments. By applying principles of conservatism and consistency, companies can provide more accurate financial information even without counting every item physically. But beyond the numbers, this scenario also reminds us the ethical weight accountants and finance professionals carry. The pressure to look good on paper can tempt people to hide losses or bend the rules, as seen in Helen's situation. Standing firm on ethical and accounting standard isn't just always easy, but it's necessary. Misstating financial statement doesn't just violate standards, it misleads investors, harms employees, and risks the company's integrity. Accurate reporting and ethical decision making aren't just about compliance, they build trust, they protect reputations, and uphold the very purpose of financial reporting. To tell the truth, in the end, doing what's right protects not just the numbers, but the people behind them.